Thank you, Bernard. Yeah, I'm Andrew Harrison. I co-lead the Green Hill Business Private Capital Advisory with Bernard. Honoured to have a strong panel ahead of us here, talking about focusing on GP-led transactions and that part of the market, and then I think we'll finish with LP-led. We'll have another panel after this as well. So before we start, why don't you just give a quick sort of 15-second elevator pitch on you and your institutions, just so everyone in the room has a view.
So Alistair Watson, I work for Aberdeen. We're a global asset manager with significant expertise in private markets. In Europe, we're very active primary investors and also very active secondary investors. So we see both sides of the GP tender and GP-led processes.
Thanks. Ivan Chenet, I'm one of the three managing directors in the secondaries program of Capital Dynamics. We're a Swiss firm. We focus on the mid-market. We manage a bit over 14 billion. We're investing in 700 funds, 300 GPs, and we have dedicated strategies like secondaries and co-investments.
Hi, my name is Ricardo Miro Quesada. I'm the partner in charge of private equity at Arcano. We are an asset manager with 9 billion euros under management across different strategies. And in our case, in private equity, we do primaries, secondaries, co-investments through dedicated funds, fund of funds, secondary funds, and so on.
Hello, I'm Greg Holden. I'm a London-based partner on the secondaries team at Adam Street Partners. We are a global private market investor with about 50 billion in assets under management.
We got to figure out how to do this. Cool. Well, why don't we start with sort of a high-level overview of what the markets have done last year and sort of transaction volumes and how active the markets were for you individually. And how you see things kind of this year as well, and what the differentiators are between the two time periods. Jan, I guess you offered to kick this one off, so if you wouldn't mind sharing your views first.
Sure. I'll take your microphone though. Well, it continued to be a very active market in 2022. I think you shared the figures, up probably about 50% over the previous peak in 2020. But GP-leds were impacted by several factors in 22. I would say the opportunity set with portfolio deals, lack of capital, and if you start with the opportunity set in the second semester of 22, portfolio deals became very interesting for us buyers. Valuations became more attractive, discounts increased, committees were generally more comfortable with more diversified deals. More downside protected, so it became harder to do GP-leds, I would say, as an investor in the second semester. So the opportunity set was probably skewed towards portfolio deals in the second semester, and that was not to the benefit of GP-leds. Lack of capital, it was probably more challenging, right, to raise capital in 22, and smaller funds or slower fundraising led to smaller tickets. And as you know, most of the capital in GP-leds is still coming from syndicate, and syndicate members were writing smaller checks. So what you saw was, especially for the larger deals, they took longer to close, maybe didn't close. Several of these deals actually rolled over to this year. And in general, there was a higher selectivity for GP-leds. I mean, really the stars had to align for these deals to go through because of, again, this capital. There's a general lack of capital still, and greater selectivity. And perhaps, as I think Bernard alluded to, the pricing disconnect, which was severe in the first semester of 22 and tended to only resolve itself towards the end of 22. So it used to be difficult to have discounts in GP-leds, and many of these started with no discount in 22, and as the year went by, you saw even the trophy assets converge to kind of 5, 6, 10, 12% discounts, and that was an interesting development. And big picture, it's a buyer's market for GP-leds, so it's really exciting.
I think that was fairly comprehensive, but has anybody else got anything else that they want to add to what Jan said?
I think probably in the first half of the year or in 2021, people were very focused on technology, healthcare assets, and then I think we saw quite a bit more diversification in terms of sectors and sector focus in the second half of the year. I think the other thing to say is, while it's a very attractive buyer's market, I think from the primary perspective, we're seeing quite a lot of challenges in terms of, normally GPs that you speak to, around this conference are saying we always sell assets at 30, 40% premium to net asset values, and then suddenly LPs are being asked to accept discounts of 10%, and the question is, why are GPs selling? Obviously, from a buyer's perspective, very attractive, but I think the industry is going to have to self-regulate a little bit over the next few years to make this really work and be a long-term market.
Actually, looks like you just read my notes, because the next question is, what do you think the key rationale for these transactions is? I mean, why are GPs doing this? I mean, single asset, multi-asset, liquidity solutions, staple tenders. I mean, obviously there's a whole array of different rationale to do it, but in terms of the deals that you've seen throughout the course of the last year, maybe pick out one or two sort of themes of why these are sort of attractive. Ricardo, if you would take this one for me.
Got it? Does it work? Yeah. Cool. Well, look, I think the reasons for GP-led obviously are very different depending on the manager and the asset. But what we're seeing is, look, on the LP side, people are definitely kind of looking for liquidity as exits have slowed down. So I think the opportunity for some of these GPs to try to give some liquidity to LPs without selling those assets, either because financing has definitely kind of been reduced compared to a year ago, or multiples have decreased, at least when you compare them to the public markets, is there. So I think a GP-led is a good way for some of these GPs to give back liquidity to their LPs, and at the same time hold to kind of very good assets in probably not the best moment to go out there to the market and try to sell them. So look, I think it's been a mix, and then if it's either a single asset or a portfolio with several multi-asset continuation vehicle, it really depends on the asset. I think given the current environment, it's not easy to go out there with low quality assets compared to what we were seeing 2-3 years ago. So if you're going to go to market in the current environment, you might as well be very well prepared as a GP and with the right assets in order to attract the right demand. Going back to your point, I think we saw a lot on healthcare and technology, which some of these assets are fantastic, but from a diversification point of view, a lot of the buyers like us are probably overexposed to some of these sectors. So it's not just a matter of the right asset, but also is it the right sector at the right moment. And I'll finalize with a point on staples that you mentioned. I think one of the benefits, at least as a platform, and I think the four of us do the same. I mean, having the capacity, I think, to do some primaries as well in some cases, staple some of these transactions in the current environment is definitely beneficial. We tend to invest, obviously, with good managers, good quality assets, but we're also trying to show that we're long-term partners. And in the current environment, having primary capacity, I think it's key, because we are able to support the manager in these secondary transactions, but also to potentially give them primary and further runway to do new deals.
Yeah, just as a follow-on. So I think your question was about like motivation and what's causing them to do it. You answered that the same way I would. The other point I would say is, as a buyer, that's the first question we're asking, is what's your motivation? You've been holding this asset for 4 years. You want to hold it for another 4 or 5 years. Let's get behind that. And I think a lot of us have a similar approach, that we're focusing our participation in these deals with managers that we know quite well. So we've been following those assets for 3 or 4 years. When they change how they're talking about the assets, we can sense that. But these deals are very different from a risk type versus what will be talked about in half an hour, I guess, on the LP trades. And this is much more about alignment and human risk and things like that. So that motivation and that story is critical.
Yeah, perfect. Again, I think my next question talks a little bit about alignment, so nice little segue.
I was reading your notes as well.
Yeah, there you go. I shouldn't disclose them before we do this in future. So, what, as an LP looking at an asset, obviously there's a lot of flow. GPs are sort of, especially your institutions, right, contacting you on a regular basis. How do you differentiate what's a good deal, what's not, what's worth spending time on? So effectively, what are the key considerations you guys look for in an asset that goes, yeah, actually it's worth spending time on this, or actually, no, we'll sort of pass on that? And with that, kind of what alignment of interest do you guys secure with the GP, in terms of carry roles and all that sort of stuff, just to make sure that kind of long-term partnership and all that sort of stuff is tied up? Alistair?
I think the first thing, as Greg said, we work generally with managers that we know extremely well. I think the long-term trust is super important in these situations, because when you come to ultimately sell the asset in a few years' time, you really want the GP on your side, and a GP that's going to really maximize value and get the right timing for you. Because they could actually hold an asset for a very long period of time if it wasn't performing well. What's the trigger for them to ultimately sell an asset in a continuation fund situation? So the GP quality is very, very important for us. And then when we look at the asset, obviously we talked a little bit about sector and diversification and the right timing for us, but it's really also about the next phase of ownership for us. Is it just that they're carrying on with the asset with no real change, or is it a new value creation phase? Is there going to be additional value creation opportunities? Is a key thing for us. So are they able to, they're going to be doing more acquisitions? Are they going to be going more international? What's the real driver for them holding the asset for longer? And then I think, we would like to see the possibility of the asset actually being sold to a third party in the end. You can't always, bank on that happening, but if you want to really, have outperformance in these deals, you need to believe you're not going to have a continuation fund of a continuation fund of a continuation fund. So it'd be interesting to see what happens on that in the long-term perspective, but we want to see positioning of a strategic asset to the right buyers in the end.
Just with that, in terms of kind of money multiple underwrite on the next go round, do you have a sort of a threshold that you actually look to, sort of a 2x plus, or how do you evaluate kind of what return expectation you'd have on that asset?
It's obviously risk-based, but we would never do a deal unless we thought we could make more than 2x net and probably 20% net IRR.
Everyone's going to say the same thing on that. So.
I was just going to add, definitely at 22, the sort of poly-crisis situation, we observed flight to safety, as you mentioned, definitely more defensive sectors. Healthcare, consumer staples, kind of recurring IT services were always in flavor for GP-led. But also infra-related services. What was out, I would say single assets became a lot more difficult. Single asset in technology at high valuation were very, very hard to place as intermediaries. But deals structured with preferred equity had a lot more traction. Essentially a flight to quality in general, and safety.
Greg, anything to add, Ricardo?
The only thing I was going to say is, to your point on alignment, I think everyone's demanding that, and they have been for the last couple of years, that the GP's putting back all their crystallized proceeds and carry into the new deals. But that's a bare minimum. I think that the deals have fallen off in terms of volume for several reasons, which we talked about. But right now, if you want to get a single asset deal done, that sector, that company has got to seem like it's bulletproof right now. Otherwise, the relative value is in the LP trades right now.
Cool. That brings us on to pricing. And Greg, hold the mic here if you wouldn't mind. How are transactions priced? I mean, I was just having a conversation with a GP about an hour ago who's never done a CV before. And he's sort of exploring it and thinking about it. He says, "Well, how do we price this? I mean, how do we, what are the mechanisms to get our LPs comfortable, our current LPs comfortable that we're obviously getting the right price for them and all that sort of stuff." So, I mean, in the trades that have gone through this year in all your organisations, what have you seen? Whether it's kind of lead buyers, price setting, minority sales, then price set, all that sort of stuff. Just kind of
all of the above. The only ones I worry about is when there was a failed IPO. Or exit, and then my price, it looks like it's going to be higher or the same. So we avoid those situations. But typically, like I said, we're doing these deals with managers that we know well. I know their valuation policy. I have a good sense for the value of that company, what kind of buffer they've got built in there. And so that's where I start my thought process around pricing. And if the lead buyers come up with something that makes sense, that's fine. If they don't, then I'm not interested. Sometimes we lead deals, and same thing. But I'm less worried about that, unless, again, it comes from a process that makes you think, why am I paying this if the market's not demanding it?
Ricardo, anything to add on that?
Yeah, I would probably say that it's on a case-by-case basis. We've seen everything, as Greg was saying, but I think it really depends also on the dynamics. Something that we probably try to avoid is when we're looking at a process or a GP-led where there's some sort of dual process, where there's also some kind of more, call it M&A, where the risk of execution, at least for us, it's higher. I mean, the pipeline, I think, for the last few years has been huge. So when prioritizing certain types of deals, we want to see that it's something from the beginning that, it'll be obviously a GP and an asset that, we'll probably end up doing further work. But if there's also sort of a risk of execution in terms of the deal not going ahead for whatever reason, like a parallel M&A process, we may actually put it in the back burner.
That was going to be my question in terms of these dual processes. How attractive are they? Because you could do all the work and then end up with nothing, right? So, Alistair, anything to add on that?
Yeah, I mean, we have seen quite a few of these dual-led processes where there's actually a third-party GP pricing, and then the existing GP wants to roll into the new deal. You could argue that the pricing dynamic for a secondary buyer there is slightly less attractive because it's been absolutely fully priced by a third party.
I'll probably add that I think when we see other GPs coming in, usually you would assume, and that's the first reaction that at least when we speak with some of our clients are saying, hey, so it's great because it's another private equity coming, so they're probably targeting at least 2.5 times or 3 or whatever. I think the benefit of having a broad platform is that you know the track records of a lot of these managers, and you know how they've performed over time. So I think it's not just a matter of having someone else come in and sort of giving you a price that you should feel comfortable because it's another private equity or buyout manager. Actually having visibility on that manager's track record in that specific sector or geography, it's key also as well.
What I thought was also interesting was that last year, syndicate members kind of pushed prices downwards because, again, of the lack of capital issue. I'm not going to name deals, but I can think of several high-profile transactions that initially priced at par of kind of low single-digit discounts by the leads or co-leads, but because of that lack of capital, the prices eventually settled in the 10-12% discount range. So it's an interesting development, I think, yeah.
I think we'll move on now to sort of the processes behind these. And so we were in New York last week with our M&A bankers and our sponsor coverage guys, and they'd done some analysis that showed that actually 50% of M&A deals last year didn't complete, sponsor-led, for one reason or another. The majority of that was actually due to the pricing that the sponsors wanted versus what the offer on the table was, and those deals were just pulled effectively. We've seen a large number of GP-led transactions also hang in the market and didn't get transacted and didn't get traded. So, I mean, from your, I spoke about the M&A piece, but from your perspective, what have you seen? What was the underlying driver behind that? Was it pricing? Was it execution risk? All that sort of stuff. And Jan, if you take that.
No, we're always as well surprised by the volume of GP-leds that did not complete or kind of rolled into 2023. And I think to your point as well, the opportunity set was more skewed towards portfolio deals because times of dislocation don't last forever, and there's a certain pressure from investment committees, for example, to focus on these portfolio deals while they last. So that's one, and then the lack of capital, that we alluded to, and the price disconnect. I mean, these are three big reasons. Certainly between the end of March and kind of late September, the market was a bit frozen, right? Because valuations were kept at elevated levels by GPs, kind of playing peekaboo with reality and public markets. And finally, looks like the market is coming to its senses, and we see the emergence of discounts even in GP-led. So that I think is probably looking good for 2023, in terms of volume and dry powder and the availability of capital.
Yeah, that last one's big for us. So for us, we look at everything over time on a relative basis. And what we've been able to see with LP trades, getting access to managers at a 20% discount that you just hardly ever get that access to. Now, there's a reason there's a buffer, right? But having that opportunity has just steered us away and steered us more towards those transactions now.
Yeah, I'll add that, look, here, I think going back also to a similar point related to LP stakes, I think, look, the pricing, and you could see it in Bernard's chart before, on LP stakes was probably quite tight in terms of discounts. When we see GP-leds that, are not necessarily being done at a discount, and the GPs are actually keeping a lot of these valuations, and we compare it to LP stakes, and we basically do 50-50. and suddenly the market is allowing you to correct for that potential lack of adjustment that the GP in some cases is doing, we'll probably go for that one, right? Because for an LP to accept something, above 10% on a GP-led, I think to date has been tricky. But on an LP stakes, we can, take advantage of some misinformation or some specific cases of an LP that needs to sell. And if you can buy some of these good quality assets at a 20%, we'll probably tilt, and that's been the case the last few months, towards some LP stakes.
I think to your point, it's always hard to justify a 10, 12% discount on something that was supposed to transact at NAV. Otherwise, what was wrong with the valuation methodology? But the issue, I think, last year was the lack of alternatives to have access to liquidity. I mean, IPOs, trade sales, sponsor to sponsor, I mean, all of that was to some extent frozen. The GP market kept on functioning, offering a liquidity option. You take it, you don't take it, but it's an option. But it looks like almost 80% of LPs elected to get liquidity, so there was a need, even though the discounts were a bit higher. Yeah.
Again, reading my notes. The next question was how have existing LPs reacted to liquidity offers? So, stay with the mic and maybe Ricardo take that, and then you can.
Yeah, I'll say that we're seeing sort of a high percentage of LPs sort of accepting the offers. I think they've come to realize, and we've come to realize as well as potential sellers, that look, we've lived in 10 years of fantastic times basically, and a lot of these are a lot of these funds or transactions are already marked up at quite nice multiples. So in an era we'll probably see 12 to 24 months of certain illiquidity and less exits. Why not just take the money basically and just accept some sort of discount, either if it's an LP stake or a GP led, and take it from there. So I think LPs are starting to be a lot more open and saying, look, okay, 6 months ago I would have sold this at 5% discount. At 12% discount, it's not such a bad option, especially when comparing to what's happening in the public markets. And I think the other thing that is also relevant is it really depends on who the LP is. I think some of us may have certain restrictions because we're investing from closed-ended funds. And some of these transactions have been in the books of some of these funds for quite a while, right? So they're also coming to an end, and sometimes you're even forced to sell. So I think there's different dynamics on why people are selling.
Most of the deals that we're seeing are not in bad funds, right? They're high quality managers. They're funds that are in carry. Like you say, the LPs have already had 2x, and they also in this day and age know how the market works. So they know that there's going to be a discount. And I would imagine, based on what we're seeing in terms of existings and how they're acting in these deals, they're all selling, right? So they want liquidity. And I think expecting what's going to be going on for the next 6 to 9 months, that's probably going to continue for a little while.
Yeah, maybe I'll add something, which is, look, we tend to think of a discount and obviously how that's going to impact the multiple, but in the current environment, we should definitely think of IRR and what will happen if we actually hold for that for another 2 years and try to maximize price. Well, it may actually not compensate. So you may actually be better off by selling at a 10, 15% discount and getting your money now and having a certain IRR than waiting and trying to get NAV in 2 years, because that's probably not going to be compensated from an IRR point of view. So again, case by case, but I think we should definitely be conscious because again, and sorry if I sound a bit negative, I think the next 12 months, because of financing markets and all the uncertainty, are not going to be net positive in terms of distributions versus capital calls.
Yeah, and Alistair, anything to add to that?
Just again, that point I was making at the start, that I think the fair treatment of LPs is pretty important. I do agree, though, that in some deals we've seen GPs really try hard to give a status quo option or really allow LPs to roll if they want, regardless. But the vast majority of people we're seeing are selling because they want some level of liquidity. I think the other thing that's interesting, we maybe going to cover later, is the interplay between LP portfolio deals and then GP leds. Because when you're buying into an LP deal, you're having to think, well, which of the assets in this portfolio are going to be going for continuation funds, and what's the optionality, and how does that all work in terms of pricing? So there's some complex issues to work through in due course.
Good luck with that, exactly. Okay, cool. I mean, I think we've got probably 2 minutes left, and then we've got 5 minutes if anyone's got any questions to ask the panelists. I think the last thing I'd ask each of you just to make one comment on is kind of outlook. I mean, we sort of alluded to it throughout the thread of the conversation we've had, but outlook for 2023, kind of how do you see the GP-led market shrinking, maturing, or what are the themes as well?
Yeah, we're starting to see a few more deals that are multi-asset deals rather than single asset. I think probably the buyer community, as we said, is more keen on multi-asset deals. That does add a bit of complexity because often you're putting some very good assets with some less good quality assets. I think the other thing to say is, as we've said, there's going to be less distributions this year in terms of full exits. So GPs wanting some liquidity to manage their fund in terms of liquidity profile. We're going to see them using this GP-led market for that. We did see a number of strip sales last year, people taking the whole portfolio and selling a slice, 10, 20, 30%. I think we may see some of that as well. So GPs holding on to the upside, but giving some optionality there. But I think it will be a pretty active market. But I think GPs are going to have to be very, very clear on the rationale and the quality of what they're bringing to market, because the secondary buyers are going to be very, very picky in terms of what they're going to do.
Yeah.
I think just looking at the long-term drivers, they're intact, right? I mean, the GPs want to hold on to their trophy assets that they know well, that they want to hold on to for another value creation cycle. That's not going to change. In terms of the lack of capital, it looks like it's better, right? I mean, it's about $130 billion in dry powder, another 90 billion estimated to be raised in secondaries. That's a lot of capital, so it's better than last year. And the price disconnect is less of a disconnect than last year. So all of that leads me to think that it should be a nice year for GP-leds, right? I mean, it's grown by 20% CAGR over the past 10 years. It's one of the fastest growing asset classes. And as buyers, it gives us access to very nice assets, trophy assets that are not available on the regular channels, right? Assets that are well-known, de-risked, further along their value creation curve. So it's looking good in my view.
Yeah, look, I think as a long-term investor, I really don't like sort of giving estimates for what's going to happen in the next few quarters. But as you're saying, I think that the long-term trends are there. I think it's going to be another good run in terms of what's going to happen in the next few years. And I think 2023, look, the lack of distributions, again, that's just going to result in GPs looking for all sorts of solution for single asset, multi-asset, tenders, and so on. So it all seems like it's going to be, I would say, a good year.
Yeah, I agree. I mean, the GPs have discovered this now. It's not going to go away. They're going to, as soon as the market allows it to go back up, it's on the demand side from our perspective, the supply is there. That's not going to be an issue. So it just has to start looking attractive again from a relative value perspective versus the LP trades. And the other thing, so that we're kind of focusing on continuation funds, we're definitely all seeing a lot more tender processes with staples. Which is kind of somewhere between the two types of deals, I guess. But that, I would imagine, as fundraising continues to be difficult for a lot of managers in the next year or so, we're going to see more and more of those, if you want to call those GP-leds as well.
Sorry, I know that was last. Just on that thread, though, I think as the market has matured, from your own fund's perspective, historically it's commingled between LP portfolios and GP-leds, and kind of that's how. But now, sort of, are you guys got sort of separate funds for GP-leds versus LP stakes, or how are you thinking of your own portfolio construction in the secondaries market?
Yeah, we don't have separate funds for those. We have the same team as well doing both of them. Listen, we're focused on buying high-quality assets from high-quality managers, and I'm less worried about that. But so our balance tends to be kind of where the market is. I think we're just below 50% GP right now on the current fund, which is probably roughly where the market was over the last 12 months or so. For me, it's about balancing the risks, because the risks are very different between those two deal types. We talked about earlier the alignment and the human risk in a GP-led. So as long as I'm balancing that, I'm less concerned about kind of where the capital is going from that perspective. But we put it all in one pot, basically.
Yeah, similar with us. We've just raised 500 million funds, so it's relatively small, and we like to keep it sort of all within.
I didn't know you just had a fundraise. Congratulations.
Thank you. If you didn't see it in social media. But I think we do like keeping it in the same pocket, because I think both have pros and cons basically, and they complement each other quite well. So we actually move, depending on where we see the best opportunities, but also from a portfolio construction point of view, one being a bit more IRR focused and the other one probably more multiple focus. we think of it as, how is it looking from a portfolio construction? It's true that we'll probably never go sort of 70-30, but between 70-40, it's sort of changed over the years depending on the market and where we were seeing the right opportunities.
Same here, same pot. On the multiples, also I think we ran an analysis on the last 30 GP-leds that we did, and they are accretive. It's largely paper gains because it's a young asset class, but it's exciting. We see the numbers kind of matching the theory. But to your point, absolutely, they complement portfolio deals, which are in normal market conditions distributing 20-25% of their NAV every year, more diversified, better foundation, GP-leds which are supposed to be and seem to be accretive in terms of the multiple. But if I look at our investments over the past 18 months, we're 70% skewed towards portfolios for the reasons discussed.
Yeah, again, we have them both within the same vehicle, so using the LP deals to drive early liquidity and then having more multiple in the longer duration GP-led deals, and we just make sure we right size for single asset concentration.
Got it. Well, that ends our tour of the GP-led market for now. We've got a couple of minutes. Has anybody got any questions that they'd like to ask these industry experts? Aha. This isn't planted, this one, is it? No one's going to admit that.
Yeah, no, I will. We have a couple deals that are underwater, but they weren't from that long ago. But we had a couple deals that are like at 0.99 or whatever because they closed at par, and then there was a FX or something like that. But that's it. No. Well, I mean, I wouldn't say I'm always worried about everything, but we haven't had anything because of the current movement in the macro. Nothing's impact. We focus on mid-market. We focus on buy and build. We're less cyclical, low leverage, that type of thing. Which I'm not saying better or worse than anything else, but it typically gets hit a little bit less in times like this. We do have some technology exposure, but it's profitable technology. It's not growth. But yeah, we got our eyes out. I am constantly monitoring, but I'm not overly worried right now. Again, to be perfectly frank, I got a couple of deals where they're below budget due to, example, healthcare staffing costs, things like that. But these are really good companies in really good spaces. The balance sheets are healthy, and the managers have cash in the funds. So I'm not, unless it continues for 2 years or something, I'm not overly worried about it.
Any more questions? No? Okay, I'll give you a free Green Hill pen if anyone asks a question.